One of the strategies that we do at Property Investors is called negative gearing. Commonly when we ask people about negative gearing, do you know how it is or how it's actually explained? A lot of people have a rough idea. We thought today we'd give you a total example that we've actually used previously with clients, and we'll base this on a past sale that we did last year. So imagine we purchased a property for $685,000. It's a house and land package where there's a block of land in the house. We'll assume that the land is worth $285,000 and we're going to build a house on it for $400,000. Hence the package total price of $685,000. The next step of that is that when you're going through and you're looking at your investment property, you've got to look at, before you purchase it, what are your actual expenses you're going to incur on that? Now, there's several forms of expenses that you're going to incur when you purchase a property. We break them down into two formats. One of the formats is actually called cash deductions. These are physical expenses you're going to incur during the life of the investment property that you must fund each year. In fact, how we determine the break-even cost of having a property and what it's actually going to cost you based on the actual expenses you're going to incur in that year. Most of these expenses are broken down. Most importantly, the biggest one is the actual loan for the property. Now, I'm going to work on a 6% interest rate. We've had a recent interest rate cut, and I don't want to talk much more about future rates, so I'll base this on a 6%. If you actually have financed the whole property, which you should be doing for maximum tax benefits, you will be borrowing either the deposit portion and the actual full loan amount for $685,000. You'll be borrowing all the money. It is the most tax effective method, of course, to do so unless you've got cash around. So I'm going to base that on, in this example, of $685,000 being borrowed. So basing that $685,000 purchase price financed at 6% for the full amount, you'll incur $41,000 worth of interest repayments that typically have to be made monthly to the bank. The other expenses that you'll have that sort of add up in the background, and that's why it's really important to be working with really good associates in your investment property process, is obviously your property manager, the leasing agent. Based on a 5% return on this property in rent, you're going to pay the property manager around about $1,800. The next thing you'll have are water rates and obviously your cancel rates. Now that's going to vary from state to state and area to area around Australia that you're investing, but commonly as a rough estimate, we'll put the rates for the property around about $2,000, including the water rates. The next fee you'll incur on the property will be the most important ones that a lot of investors don't take into account, and that is insurances. Now, the two forms of insurance that you want to be working with on your investment property, obviously number one, you want to insure the property. So that's the building insurance. A lot of people don't realize that there are some contents items as part of the landlord's responsibility to make sure you take out, such as the curtain, the drapes, and those sort of amenities that do suffer wear and tear, that if are damaged by the tenant's landlord's insurance may not cover them. The other actual policy that we are talking about here is landlord's insurance. This is the peace of mind that most landlords worry about. What if I get a bad tenant? Well, obviously a good property manager filters that process, and having a history of reporting, you won't have the need to be worried about as much, but it's peace of mind should an event happen with actual tenant where the property does need to have maintenance on it. That policy, depending on your state, is about $420. So your insurances for the year in total are around about $1,500. Now, we mainly at Property Investors, we deal with new properties because obviously we're talking about the tax deductions, which I'll get to in a second. So with that, we do get 25-year building warranties, and obviously we get 7-year internal warranties on all of our properties. There won't be much maintenance required for the property that we haven't actually put aside, but we'll just put a little budget there of about $300 for perhaps rubbish removal or things that the tenant may have left behind, so that we can actually, when the new tenant moves in, have a beautifully presented property when they do take over. So the total of all those expenses, just in the running costs and actually insurances, they're going to total up to $46,300. That is what we call your break-even point. That's how much you physically need to find each year to have that property pay for itself. So that's our cash deductions. The next section that we work through is actually the non-cash deduction. And this is probably one of the most important parts of why we always try and choose new properties. It's where you maximize your tax returns by having a deduction that you can claim from your tax each year that you're physically not paying for, like the loan, where you've got to find the money. This is a paper write-off on your property. And there's two forms of actual deductions we're going to look at. The very first one, which most people have probably heard the term of before, is actually called fixtures and fittings. And that's where we're writing off items like the oven, the hot plates, the air conditioner, basically any amenity in the property that can be physically removed. And we're talking curtains, drapes, carpets, light fittings, those sort of items. Typically in a property, In this house we're talking about here, remember the house of $400,000, $40,000 of that will be fixtures and fitting depreciation. Now this figure of $40,000 is written off over a reducing balance. What that means is that the figure will actually diminish over the period of time, typically around about 15 years, where you see most of the deductions taken away. In the first year, in this example, we've discovered that the property will have a $7,000 fixtures and fitting depreciation. So we're going to put that into our calculation. The next major depreciation item in the home is actually the full construction side of the house. You know, the concrete, the building, the walls, the roof, all of those items. In this example, we've used $40,000 of the $400,000 for fixtures and fittings. The other $360,000 is now the building, right? Now, the building actually gets written off over a 40-year period. What that means is that you can have a house on a property and after 40 years, you've written the whole entire price of the property off through taxation. So 40 years of the remaining $360,000, in this case at 2.5% or 40 years, means that you actually have a deduction on the property as a flat fee every year for 40 years off your tax of $9,000. So when we put together our depreciation or our non-cash deduction claims that we can make on tax, in this example, we've got another total there of $16,000. So when we put together our two forms of deductions, we have our cash deductions of $46,300, and then we have our non-cash deductions of $16,000. When we add those two items together, off our tax, we're able to put together a claim of $62,300 a year in cash deductions, which are the expenses, and the non-cash deductions, which is the paper write-off. That will take off our tax when we go through it. When you purchase any property, and whether it be your own home or whether you're buying something for an investment especially, you need to understand the local rental market. You need to make sure there's adequate demand, that your property is not only sitting vacant, but also your property when you do lease it out is you're maximising your return. A good property manager is going to be trying to target anywhere between 4.5 to 5.5 to 6% as a rental yield. Remember, they make their revenue by getting you more rent. So in this example, I put a rental return on this property of just 5%, or basically about $650 a week. What that totals up to is $33,800 a year. That's your income that you're receiving from the property, or portion of your income. So your rental return is a key aspect of the success of your investment journey. That research is very important. Now that we've got obviously our rental income, we've got our expenses, now it's time to go see our tax man to do our tax return. Hence the reason where we're looking at negative gearing. So the other form of income that we want to generate from the property is some form of tax benefit for us. So let's have a look at the example we're using here for a client who's got a family household income of $130,000. Based on their current taxable income, it's $29,788 per year that they're currently paying in tax. Now, when we add to the $130,000 income, when we go to the accountant, we're going to add the rent of $33,800. That's going to give us a total gross revenue for the year coming into our household of $163,800 before we do any deductions. Now, if we go back to our calculation earlier and we remember our depreciation and also our cash deduction figures of $62,300, when we subtract that away from our income, we're left with $101,500. This figure now forms the new taxable income that we should be paying tax on, rather than our previous income of $130,000. What that means is we're entitled to a tax rebate at the end of the year, or varied throughout the year, and I'll talk about that in a minute. Based on $101,500, your new tax that you should be paying is $21,238. So when we take in the amount you have been paying at $130,000 and the new taxable income that you're now declaring, you're going to get a rebate in tax back to you on tax you've already paid of $8,550. So when we add together the amount that we're getting from the tax man of $8,550, we have an income coming to the property of the combined rent and tax of $42,350. Now, we weigh that up against our break-even cash. So remember earlier I mentioned the cash deductions that we have to pay. We have a total figure there of $46,300. When we subtract that $46,300 from the income we're receiving, after we've subtracted the revenue that we're getting on the property from the tax and the rent, and we take away our cash deductions that we need to get to meet our break even, we're left with a total amount owing out of our own pocket of $3,950. Or on a weekly basis, this property is costing you $75 a week. And this is one of the key strategies that people need to look at, is how they're going to be cash flow and afford the property for a long term. The assumptions that a lot of companies would use that property will double every 10 years. At Property Investors, we're a little bit more conservative about our approaches and those things. And let's just say the property's gone up by only $400,000. That's $75 a week, or that $3,900 a year. You're going to get a return of over $400,000. Based on this little negative gearing strategy, I'm pretty sure you'd agree it's not a bad way and a great return to get your portfolio started. So before we do move on, a lot of people then saying, well, yeah, I've got to wait to the end of the year for that tax return of $8,550. The reality is that's not true. There's been many terms used over the years that I've been investing with property. Tax deduction 22(1)(d), then it went to the section 1515, now under the new MyGov system. You're able to actually claim that tax deduction that you would normally do at the end of the year. You're able to sit with your accountant or on your MyGov account and actually forecast your tax return for the year ahead. And what you're able to do is, instead of actually waiting for the full lump sum to come in annually, you're able to get a rebate of that $8,550 based on the frequency of your pay. That figure of $8,550, if you get paid weekly, you'd see 52 weeks of the year, and that balance back in your account. If you're fortnightly, 26, or if you're getting paid monthly, you'd see that divided by 12. So sometimes we're seeing clients get an extra $200 to $400 a week back in their pay packet, or fortnightly in their pay packet. Right? Now that's a very clever way of actually utilizing the cash flow of the property, because you're not waiting to the end of the year having to come up with your $75 a week plus the tax portion. You're able to fund your property throughout the year with only that $75 a week coming out of your budget. A few other strategies that play a very important part in speaking with your mortgage brokers, you'll see, having that assisted cash flow coming in each week or fortnight before the monthly repayments due on your mortgage or on your investment property. You could have those funds sitting in your offset account of your own personal home. That's actually just a smart way to reduce paying your own home off. So negative gearing with tax benefits and reducing your home mortgage, just some of the simple strategies that you should be looking at to add to your portfolio process.